Good morning, good morning, good morning. It is Friday, the 6th of March. We finally made it through the end of the week. This is the Morning Blast with myself and Michael Brown. As usual, you know the score by now. A very, very candid take on markets. Hopefully add a bit of value to your day, put a smile on your face, etc. Nothing we say on this podcast is trading or investment advice. You have been warned regarding trigger words, etc., etc. We do not pull our punches, and there's no editing, and swearing is actively encouraged. Michael, how are you? How's the week been in general for you?
Indeed. Very good morning to you, Ryan. Very good morning, everyone. A very Friday, of course. Bloody hell. It's been a hell of a week, hasn't it?
Hell of a week.
Thank the fucking Lord we've got to the end of it. We've got, the small matter of a jobs report to get through and probably a barrage more geopolitical headlines. And then I think everyone will be either, going to the local watering hole or crawling off to lie down in a darkened room for a while.
Well, I got to say, though, the most important jobs data has already come out this week, which is obviously the mighty ADP. But for the purists, anyway. The bookie nerds still want to rely on their NFP, but that's fine with me.
That's me, basically, is what Ryan's alluding to there, in case people hadn't worked that out.
And far too many other people. NFP is dead. Long live ADP. But
that one ain't going to catch on.
No, I need to work on it. I need to work on my delivery. Anyway, moving on so we can get cracking. We will talk about NFP shortly. But first off, a market update and levels to watch, etc. from our dear friend Clive Lambert over at Futures Techs, who's informed us there won't be one on Monday because he's out in Lanzarote with the boys.
Well, he's slack. It's a disgrace, I think.
Exactly that. So anyway, what has happened? So the S&P continued its mixed bag week with some red yesterday. It's been very much, sometimes they're up, sometimes they're down. The Nasdaq is still above strong support at 24,240 and 23,905. So no big sell signal coming there. This is also holding above its 200-day simple moving average. And me and Michael both big fans of the old 200-day moving average. So, all is right in the world as long as that holds. The DAX sold off from resistance at 24,308 to 312 and posted a large red candle with Marabouzi resistance at 24,077. Eurostoxx futures hit resistance at 59.20 to 28 and sold off back to 57.38. FTSE futures here in the UK had another look at Fibonacci support at 10,359, but it's still north of here as we kick off today. So that's one for the bulls to be cheering. In the bond space, US T-notes and bond futures both followed Monday's powerful bearish engulfing pattern, which is a reversal with further weakness. Another red candle yesterday, 127.63 is now resistance to watch on any recovery there. The short end of the curve looks even more bearish. The Schatz, which is the German 2-year, selling off to levels not seen since 2024 yesterday. Eurodollar and cable both posted doji candles, small body, long wick, a bit like myself, so going nowhere for now. Bitcoin shied away from the 74,000 level that we highlighted yesterday back to 70,000 overnight. Most metal markets saw sideways to lower trading yesterday. Aluminium on the LME saw some upside rejection, but we're not seeing any follow through from the bears yet today. So buy your beds and see what happens. In energy space, Brent made new high for this move up to 86.28, the highest print for the front month since July 2024. Above here, we can target 89.30 next. WTI had an even better day. And if we close above 78.40 tonight, we could get a big buy signal on the weekly chart. So one to keep an eye on there. That's the level to keep an eye on. Gas oil, so basically European diesel, has hit resistance at 1,050. And we're seeing some opposite trade profit taking perhaps up at these levels. European gas, TTF, hasn't gone near Tuesday's 65.79 high since it printed that. And it put some red on the chart yesterday for the second day in a row. 52.12 is now resistance. Please note, there's no, again, I've already covered this, but as Clive said, please note, no wrap on Monday because he's gone for a long weekend. But thanks for that, Clive.
Very good. And thank you, Clive. I must ask you a question. Clive's just made a slanderous accusation. He says, I swear he does this better when he's pissed. Were you out on the beer last night, right?
No, I think he's saying that I didn't do this very well today.
Oh, I thought you were getting through that in good order, but
To be honest, I blame the way he words it. It doesn't read very well out loud. But, yeah.
Well, what is it they say? Bad workman blames his tools. And
Yeah, and I'm happy to do that because I'm a bad workman.
I think you could say because Clive's a tool, but you know.
Hey,
Sorry, Clive.
Yeah, no drinks, no drinky booze for me yesterday. Well, I did go to the pub, but that was just to see my friend and his dogs, and then back home with a pizza. To be honest, if you want my full social lifestyle.
Well, that reassures me greatly, Ryan. Thank you very much indeed.
You're welcome.
Right. Where are we this morning? It was another pretty risk-averse day yesterday, actually, for financial markets. Crude really remaining the main driver of proceedings, both Brent and WTI up by around 6 or 7% yesterday, and actually benchmarks testing yesterday's highs as I speak this morning. And markets elsewhere really taking their lead on that, with stocks closing lower, trends closing lower, higher yields, higher inflation expectations coming through, and the dollar firming a touch against most peers. It must be said that conditions in the foreign exchange market have calmed down relatively, well, quite a lot actually, compared to what we see in terms of market volatility elsewhere. As for geopolitical news flow, of course, a deluge of headlines again. If you do want every single headline, go and read Zach Eisman's overnight news roundup because he will be covering all of them. News flow out of the US has focused largely in terms of crude and in terms of the Strait of Hormuz over the last 24 hours or so. We did have some news yesterday that the Treasury has eased a handful of oil sanctions on the Kremlin, allowing Indian refineries to buy Russian crude, which is already at sea. So to be clear, the crude had to be loaded into a tanker by the 5th of March, so yesterday, and Indian refineries will then be able to buy that until early April. So again, the Trump administration trying to relieve some of this upward pressure that we see on price. There's also been some chatter about the Treasury Department potentially trading crude futures. If they need a trader, I know where they can get one. He used to be very, very good back in the day. He doesn't like to mention it too much. Although the Trump administration have ruled that out for the time being, there were also reports that China...
Just to clarify on that, what they're basically saying is they will be selling futures to try and keep the price low.
Yes. Well, they're not... Yeah. They're not going to buy, are they?
Well, let's just make it clear, though.
They're fair play. I was hoping that would be relatively self-explanatory, but you're absolutely right. They will be selling crude futures to try and bring prices lower. There were also reports yesterday that China has been communicating via some back channels with Iran to allow the safe passage of oil and gas through the Straits of Hormuz. So obviously we'll continue to monitor that one pretty closely. The Iranians are still saying they have no intention of closing the Straits of Hormuz, but obviously shipping traffic through the strait is effectively halted at this moment in time. There have been just 2 commercial transits in the last 24 hours, and that is largely as a result of, firstly, insurance, and secondly, the risk associated with those transits, both in terms of people, but also in terms of assets. The last thing you want to do if you own a tanker is send it through and run the risk of you losing that tanker if it's attacked by, whatever it may be attacked by. As for other bits and bobs from yesterday, news flow elsewhere was relatively light, it must be said. On the trade front, the Wall Street Journal were reporting that Treasury Secretary Scott Bessent has reportedly been considering asking China to lower its oil purchases from rivals of the United States, and also potentially asking China to buy more soybeans and Boeing airplanes from the States as well. Of course, view this through the lens of the US trying to get some leverage ahead of this Trump-Xi meeting that is due to take place, I think, the back end of this month, early April. Trump is obviously going off to Beijing, so that is something to keep an eye on. And also President Trump facing another legal challenge on the tariff front. Of course, you recall that the IEEPA tariffs were struck down by the Supreme Court, 2, maybe 3 weeks ago now. The Trump administration imposing a global tariff under Section 122 at 10% is due to go up to 15% at some point. 12 states in the United States have now sued the administration to try and prevent those tariffs from going into place. So again, the only real winners from this are the trade trade lawyers and the legal experts. From a practical perspective, I don't think this is going to make much difference whatsoever. Just a few other bits and bobs from yesterday before we move on to our discussion points this morning. On the data front, we did have the weekly jobless claims stats out of the United States. Initial claims at 213,000. In the week to the 28th of February, pretty much unchanged from the prior. Continuing claims, they came in at 1.868 million, marginally up from the 1.833 that we saw previously, although neither of those prints pertains to the February non-farm payroll survey week, and we of course get that data at lunchtime today. And we also heard from ECB President Christine Lagarde yesterday. Money markets have gone a little bit berserk when it comes to the ECB. Headlines crossing Bloomberg as I speak that the market now pricing an 80% chance that the ECB deliver a rate hike this year. Christine Lagarde not being drawn on that whatsoever yesterday, repeating that they decide their monetary policy on a meeting-by-meeting basis based on incoming data and that they have no preset stance. She was also asked about this whole thing around her potentially leaving early and simply replied with, "My term expires in October 2027, which again is not a denial. This is the easiest story in the world to kill if you wanted to kill it. The fact that she hasn't killed it suggests that actually there is, very much a case of no smoke without fire, and she could be considering leaving the bank early." But that is pretty much it in terms of yesterday, other than the Spurs losing again. They in big trouble.
That is definitely newsworthy.
Shame.
Yes. Oh, yeah. Heart bleeds for them. It's still mathematically possible for them to get relegated, right?
Not just mathematically possible. I think they are going to get relegated. They're the only Premier League team not to have won this year.
Oh, it's just. I don't know about you, but I've just got a massive smile on my face when you say that.
I know. So do I.
Anyway,
obviously, I hope we win the league, but it would just be the cherry on top of this rather nice big cake if they went down in the same season.
Yeah, I'm a bit nervous about us winning the league. I'm not too sure about it, but imagine us winning and them going down. Oh, what a dream. But anyway.
Brilliant.
Today. Anyway, back to the show. And we're not sorry if there's any Spurs fans listening. You're fucking mugs. But anyway, sorry.
Goodbye.
And goodbye. Never liked you anyway. Obviously today, what have we got? We got February NFP. That drops today, obviously at 8:30 Eastern time, 1:30 UK time. Consensus is somewhere around 80 to 100,000. January surprise to the upside at 130,000 against the 70 expectation. We had ADP on Tuesday, came in at 63,000, best reading since July. The bigger question, though, for you and for anyone else out there listening is, does anyone care? We're on day 7, day 6, or whatever it is of the Iran conflict. Hormuz is effectively shut. Oil is up roughly 20% in a week. Kospi, that crashed 12% on this private credit contagion, or whatever you want to call it. Whatever the reason.
And then gained it all back the next day.
Gained it all back. It bounced 10%. Gold, silver, bonds, equities, all enormous intraday swings. And NFP will land in the middle of a market that's pricing geopolitical risk, not economic data. What's your thoughts on this?
It's a bit of a weird one, to be completely honest with you, because of course, normally we'd be sat here and going, it's a key data release, has market leading potential, et cetera, et cetera, et cetera. I would, it's of course something that participants still need to have on the radar, still need to monitor very closely, but I would be very surprised if payrolls moves the market. The only way I can see there being a sort of material and prolonged market reaction to the jobs report this afternoon is if it is a massively out of consensus print in either direction. If we get a figure broadly in line with expectations, the market is very quickly going to move on, shrug it off, and go back to focusing on the geopolitical news flow. And the most important reason why it's likely to be a little bit of a non-event, or as much of a non-event as these things ever can be, is simply because it's unlikely to really materially move the needle in terms of what the Fed are thinking.
Yeah.
We already know that the Fed are in this sort of wait and see mode. They shifted to that stance in January. The energy price shock and the potential upside inflation risks that come from that really just reinforce the idea that the Fed are going to stand pat and sit on their hands for the time being. So I don't think it's going to have massive policy implications. Just on that front, it is worth bearing in mind that markets pricing basically nothing for either the March or the April FOMC meetings. The next 25 basis point cut, that's not fully discounted until September. And we've got about 37 basis points worth of easing discounted in the curve by the end of the year. That's obviously significantly more hawkish than we were this time last week, basically entirely due to where energy prices have gone. In terms of that payrolls report, just in the interest of good order, as you said, consensus is about 55,000 for the headline print. That would be down the 130,000 that we saw in January. Just a few things that are worth bearing in mind in terms of that headline number. Firstly is weather. Of course, the US went through a very, very cold snap in late January, early February. That was before the survey week, but there is potentially likely to still be some detrimental impact of that in the data that we get later on today. The other thing that a lot of people are looking at, again, is healthcare for two reasons. One, healthcare basically underpinned all of the job gains that we saw in 2025, at least in the private sector. Secondly, the month-on-month increase in healthcare jobs in January, which was 125,000, that was 2.5 times the 12-month average and the highest month-on-month healthcare print in over 5 years, which suggests that there's something a bit odd going on with that number, and there is the potential for that to reverse and drag headline payrolls growth lower this time out. Just in terms of other areas of the report, very quickly, average earnings, they're seen rising by 0.3% on the month and by 3.7% on the year. Not really of any concern to the Fed, if we're being completely honest. And then the household survey, unemployment, that's seen unchanged at 4.3%. And participation, that's also seen unchanged at 62.5%. So we do have the jobs report, but as I just said, unless it's a material surprise compared to those consensus figures, I really don't think it's going to be as much of a market mover as we've kind of come to expect.
Exactly that. And speaking of market movers, I think we're both in agreement that potentially the biggest moves today could come from the Friday positioning, de-risking ahead into going into the weekend. That, let's be honest, people didn't really want to hold much risk before this event because we were all expecting something to happen. Now the war is kicking off. Well, I know it's not officially a war yet, but you know what I mean. What do we expect for this Friday de-risking? As what you would normally associate would be equity longs getting trimmed. No one's going to be short crude over the weekend, are they?
Well, maybe dollar you need to give your head a wobble if you're going to be.
Yeah, exactly.
But no, I think that's exactly what you would expect to see. As you say, for the last sort of 2 or 3 weeks, participants have been really reluctant to hold much by way of exposure over the weekend. And that was before we had missiles flying around in the Middle East. Now we do have missiles flying around in the Middle East. Tough to imagine that appetite to hold exposure to risk would have increased. If anything, it would have decreased even further. So yeah, I think the natural moves that you would expect would be equity longs being trimmed. No one's going to want to be short crude. I think gold is liable to roll over a little bit as well. Gold has not been acting as a safe haven in recent weeks. Gold has been acting as more of a momentum driven asset, basically trading kind of tick for tick with equity futures. So potential downside risks there. And as you said, the real haven has been the dollar. The dollar had a really decent week and pretty much the only thing that anyone has wanted to buy besides crude. So you would imagine that that's the sort of vibe that we see throughout the day today. Again, this is the sort of thing that you normally see coming in later in the session as people start to head for the exits, although the labour market report may complicate matters a little bit on that front because people might just want to take risk off the table before that data crosses and not wait until we get closer to the close.
And also because this is you could say this is such an obviously, this is such an obvious day to de-risk ahead of this weekend because, as we said, everything that is going on. You'll end up then getting into this cycle of people trying to front run other people de-risking. So rather than just a typical Friday where it be, end of the session, people start winding down their positions, when everyone is looking around at each other going, well, hang on, I know you're going to also do the same thing. I'm going to do it a little bit earlier than you. Next person goes, well, hang on, if everyone else is going to start looking to go earlier, I'm going to go even earlier. So, it's like what we see kind of month-end rebalancing and stuff where it used to be the last couple of days, but then it kind of, now it's like just the last entire week where everyone's trying to front run everyone else. So it'd be an interesting session. One thing I would say, personally, I won't really be. What's the best way to phrase this? I'll be happy to ignore today's price action in the scheme of things, because I think this is just one of those days where, it's not really going to tell us much about the overall vibe of the market. Does that make sense?
Yeah, I think you're absolutely right. And I'm right on both counts there. I think you can almost discount trying to get any signal whatsoever from the market moves that we see today. That's just not going to happen, let's be completely honest, because it could be a complete choppy and unadulterated mess. The other thing is, well, I was going to say it's not rocket science to believe that people go off today. If you and I have managed to identify that that's likely to happen, then I think most of the rest of the market are going to be ahead of us. But on a serious note, there is a lot of risk, and I think everyone who is running a book is going to be sat there at their desk today going, do I want to hold these positions into 48 hours of unknown geopolitical risk and tension within the Middle East? As we've said quite a few times recently, there is absolutely no harm and closing out those positions on a Friday afternoon. And then if nothing happens, or if there's no deterioration in sentiment as we get to the start of the new week, then you can just put them back on again. That's not a particular problem. You're going to pay a little bit of spread and a little bit of commission, of course, but at least you're going to be able to sleep at night. So, I think that's very much going to be the way that participants are thinking about things as we move through today. It's also the sort of thing where it's worth bearing in mind if we were to see, stocks start to lurch a little bit lower, or we were to see, broader risk aversion beginning to creep in. It doesn't feel like the sort of market where participants are going to want to, catch a falling knife, so to speak. I don't think there's many people out there who are sat there on a Friday afternoon going, do you know what? I'm going to buy the dip. That's not going to be the mindset that we see today. Over the longer run, absolutely, I think equity dips are still a buying opportunity. But in the here and now, where even the market gets a little bit of momentum in terms of risk aversion behind it, that's the sort of thing that could just run on and on and on. Everyone is going to be trying to do the same thing.
Yeah, I mean, exactly that. I think if we do start seeing some kind of quite serious selling today, I think people will be just looking at it going, God, I hope it's down here on Monday.
Yeah, exactly that. So I could scoop it up because, it sort of defeats the object of everything we just said if you scoop it up on a Friday. Is there anything else going on? Yes, there is quite a lot going on today, actually, to be completely honest with you. Again, it's questionable the degree to which any of it will matter, but we'll go through. 10 o'clock this morning, we get the latest GDP figures out of the eurozone. This is final data for Q4, set to show the economy having grown by 0.3% on a quarter-on-quarter basis, which would be unrevised from what we saw, in the initial and second estimates that we got last month. We also have the latest US retail sales data out today, and that comes out at the same time as the jobs report, so it's going to be very much over. The headline retail sales set to have fallen by 0.3% on a month-on-month basis in January. That will be compared to stagnation that we saw in December. We've also got quite a lot of Fed speakers today. We're due to hear from Waller, Daly, Goolsby, Paul Mid, Collins and Hammack, who are all speaking throughout the day today, although I'm sure you'll be very relieved to learn that the Fed's pre-meeting blackout period starts at close of business. So that's just them to get their remarks in before they're not allowed to speak anymore. We're also due to hear from the ECB, Schnabel and Cipollone throughout the day as well. And of course, as we've just spent some time discussing, do be aware for the potential of some de-risking as we move into the weekend. And secondly, the potential for gapping risk at the open on Sunday night, Monday morning, depending on where you are, depending on what happens over the weekend. But for this morning, for this week, that's all from me.
And that's all from me. Michael, pleasure as always. Listeners, thank you as always for tuning in. We really do appreciate you, especially those of you that decide to listen in live. Not that it changes when we record it, because again, I'm not smart enough to edit the show, so it comes out. Whatever, hope you've had a great week. Whatever you're doing this weekend, keep it tight, stay safe, and we'll see you